Warren Buffett has never been a big real estate guy, but at an annual meeting, he gave a veiled warning on the sector.
Most people like to buy with non-recourse in real estate, but it all has consequences, and I think we are starting to see the consequences.
What are these consequences that he's talking about? And is 2025 really going to be the year of reckoning in real estate? A few years ago, money was dirt cheap. From 2020 to early 2022, the federal funds rate was just 0.25%. The federal funds rate is the rate at which banks can borrow money. If it's low, banks can borrow money cheaply and therefore lend money cheaply too. Because the federal funds rate for those few years in the past was so low, they could lend money at a minimal rate. As Buffett said, they could lend at 2.5%.
People who could borrow at 2.5%.
So when you are lending money at 2.5%, obviously a lot of people are going to take you up on this offer. It's what you call cheap money. You tell me I can just go buy commercial real estate and pay 2.5% each year in interest? That's a steal. And of course, much of this debt was what's called non-recourse debt.
Most people like to buy with non-recourse in real estate.
Do you guys know what non-recourse debt is? Well, for those who don't, recourse refers to the right of a lender to claim the borrower's assets if they fail to repay a loan. So let's say the guy who borrows the money from the bank cannot pay the yearly interest on his borrowed money. Well, the bank can go after this guy's other assets like his house, his car, or his savings to get its money back. Non-recourse is exactly the opposite. If the guy fails to repay the interest on the loan with non-recourse, the borrower is not personally liable for the debt beyond the value of the real estate. The bank can seize the real estate itself, but cannot pursue the guy's other personal assets or income to cover the remaining balance.
Most people like to buy with non-recourse in real estate. And one time I asked Charlie, there was some real estate guy we were talking to him, and how do they decide how much a building like this is worth? The answer is it's whatever they can borrow without signing their name. And if you look at real estate generally, you'll understand what the phenomena that's happening if you remind yourself that that's the attitude of most people that have become big in the real estate business.
So back in 2021, not only was it cheap for people to borrow, the loan was also non-recourse. If they fail to repay, no worries, no one's going to come after their own assets. So what happens? Well, it's obvious. A bunch of people borrow money. With commercial real estate, normally people fix the loans for 3 to 5 years. AKA, the interest on the loan stays at the level they agreed in 2022, and then in 3 to 5 years' time, they have to refix it based on what the new interest rate is. But this is where the problem lies. When you can borrow money at the cheap interest rate, everything's fine. Everyone is happy, from the bank to the borrower to the real estate market itself. The drinks are flowing and those at the ball are having a whale of a time. But what happens when it comes to refixing the rate? Well, look at what's happened with interest rates over the past few years, and we all know what has happened. It's increased. And it's at this point of the cycle where we are sitting now, where the debt is due for refixing. We've got this wall of US commercial real estate debt coming due now and over the next few years. 2025 is bigger than last year, 26 is bigger than 25, and the biggest is coming due in 2027. Some people are going to be in for a rude awakening, because with interest rates having increased, what's going to happen? Well, people are going to have to refix their loans based on this higher rate. Yeah, they could afford it when the rate was super low. Who couldn't? But at the higher rate, many companies and people simply cannot afford it. The 2.5% loans that you could get back then has increased to around 7% today.
Now check this out. When this debt literally went into place, when it was originated, it was somewhere between 2 and 3%. Okay, stay with me here because I'm going to show you the magnitude of this problem is so enormous and will create such an opportunity for you and your family to actually invest in real estate. This loan was done at 2 or 3% today and now is due at 7% interest.
That's a big jump, 2.5% to 7%. That's an increase of near 3 times the amount. The debt is 3 times more expensive. So many people simply cannot afford this. So what happens? Does the bank come and seize the real estate and the personal assets of the borrower? No, they just take the real estate. But the bank doesn't want to own the real estate. They're a bank, not a real estate developer, so they sell. And okay, it's fine when this just happens to a few properties, but what happens when a lot of commercial real estate is foreclosed on? I can't say I'm an expert in economics, but supply and demand, Eco 101, when the supply increases and all else remains the same, the price goes one direction. No, not that one direction. I mean, you know what I mean. The price goes down, okay? Come on, editor.
And it does mean then that the lenders are the ones that get the property. And of course, they don't want the property usually. So then the real estate operator counts on negotiating with them. And the banks tend to extend and pretend. And there's all kinds of activities that arrive out of commercial real estate development, which occurs on a big scale. But it all has consequences. And I think we're about, well, we are starting to see the consequences of people who could borrow at 2.5% and find out it doesn't work at current rates, and they hand it back to somebody that gave them all the money they needed to build it.
It's the typical story of Cinderella at the ball. When the drinks are flowing and interest rates are low, everyone has a good time. But eventually, reality has to kick in, the party must end, midnight strikes, aka interest rates rise. When this happens, there's a rush for the door. No one can afford to pay their loan, and the banks take over the property and are forced to sell. When you have a lot of banks selling property, they're not necessarily patient with their selling. They can't just sit on the property for a reasonable period of time so that they can get an appropriate price like a normal owner would. A normal owner would say, hey, the property market's not doing great, let me wait for a while for prices to stabilize a bit so that I can at least get a fair deal on my property. With a bank, they need to sell the property ASAP. If they don't, it can be very costly due to maintenance, taxes, insurance, potential depreciation that a bank wants no part of at all. If they have to get a lower price, they don't mind too much. In the end, it's not their money, just as long as the property's sold and it's out of their hands. What happens to the commercial property market when you have sellers who have to sell in large amounts?
This question comes from Tom Seymour. He says the first sentence of a recent Financial Times article read, Charlie Munger has warned of a brewing storm in the U.S. commercial property market, with American banks full of what he said were bad loans as property prices fall. Please elaborate on what's going on in commercial real estate. How bad will the losses be, and what sectors or geographies look particularly bad?
Well, Berkshire's never been very active in commercial real estate. It works better for taxable investors than it does for corporations taxed the way Berkshire is. So I don't anticipate huge effects on Berkshire, but I do think that the hollowing out of the downtowns in the United States and elsewhere in the world is going to be quite significant and quite unpleasant. I think the country will get through it all right, but as they say, it will often involve a different set of owners.
Yeah, and the buildings don't go away, but
the owners do.
That is an ominous warning for commercial property owners. It's important to note that this shareholders meeting was held back in 2023, back when Charlie Munger was alive. Rest in peace, the great Charlie Munger. The reason why what he was saying is relevant for today is because yes, some of the debt he's talking about has already come due, but most of it is maturing in 2025, 2026, 27, and 28. It's during this period where they're going to have to refix at the higher interest rate, and many people simply will not be able to afford this. The big question is, are we gonna see a commercial real estate crash because of this? Commercial real estate is made up of a couple of key sectors. This graph shows you the investment volume by each sector. The first sector is offices, then you have retail, industrial, multifamily, then hotel, and then other. Important to note how the volume of each sector has decreased significantly. People are investing in each sector a lot less. We all know why. And this graph breaks down the share of commercial real estate investments by sector. The largest right now is the industrial sector, which has gained a large percent of the market. Second largest is multifamily, which has decreased a lot. Third is office, whose percentage has also gone down. And the fourth is retail. So that gives you an idea of what the commercial real estate market is made up of. Now, to try and get a feel for what may happen to this sector in the future, we need to see what has happened in the past. So in 2023, 2023 and 2024, some of this debt that Munger was talking about has already come due. What happened as a result of this? Well, this is where things get interesting. The commercial real estate market in turn has actually dipped. From 2022 to 2024, the Green Street Commercial Property Price Index has gone down from 155 points to 122 points. That, in terms of percentage, is a 21% downturn. That's quite a big dip, considering if you look at the housing collapse back in 2008, that dipped from 98 points to 63 points. That was a 35% downturn. So today, it isn't on the scale of 2008, but it's certainly not an insignificant decrease either. If we just look at that decrease from a different angle, the market's decreased by 8% in 2 consecutive quarters. We have not seen a negative decrease this large for quite some quarters. I mean, we have seen negative decreases, but normally those negatives were 1 or 2% downturns. It's quite interesting that the market has actually played out kind of similar to what Munger was talking about. Maybe he does have some wisdom that we can learn from after all. So that's what happened in the past, and now let's get out our crystal ball and think through what may happen to the real estate market in the future. Because as we already know, Berkshire is sitting on a record amount of cash, and as the S&P 500 recently dipped into correction territory, Buffett is investing more and more into Japan. Keep in mind, this is the same guy who has said that investing in America and American businesses is the way to go, and he's now diversifying away from the S&P 500. But the most successful investors often cite that diversifying your portfolio among different asset classes can provide even greater protection. And one globally traded asset class has been trending upwards by several metrics amidst this stock market chaos. I'm talking about the fine art market, which just saw 2 headline auctions even as the S&P was on its way into a correction. Now, I'm obviously not an art collector, but that's the point. This is another asset class for investment, and likely a growing one. A 2023 study by Deloitte estimated the overall arts and collectibles wealth was at nearly 2.2 trillion and projected it could hit almost 2.9 trillion next year, leaving room for potential upside. Luckily, diversifying a slice of your own portfolio into art is easy with Masterworks, today's sponsor. Masterworks' 450 plus offerings have over $1 billion of invested capital from 65,000 plus investors, with previous art offerings featuring legends like Picasso and Banksy. Each of Masterworks' 23 exits has been profitable, distributing back over $60 million to investors, including principal. Investors who didn't need millions or our expertise. While the channel can't invest, my subscribers can get special priority access with the link or QR code on the screen, or by clicking the link in the description. So, back to what may happen in the real estate market going forward. What's our forecast? Which of course is going to be 100% accurate, and listen to everything I say with no grains of salt, because when you forecast things, they're always correct. So this wall of real estate mortgages that are due to mature over these next couple of years that we've kept referring back to throughout the video, it's not a minuscule amount. A wall is a reasonable way of describing it. 998 billion in 25, 1.4 trillion in 2026, 1.2 trillion in 27, and 1.1 trillion in 28. There's no doubt that when it matures, they're gonna have to take on a higher interest rate. Interest rates are not what they were from 2009 to 2022. We're in a different era now, and the federal funds rate is higher. We don't know how high it's going to stay, but it will be higher than what it was in the past, which means in turn the mortgage rates are higher too. Now there is going to be a group of people who simply cannot afford this, and as talked about, they're going to have to give their real estate back to the bank, and the bank obviously in turn will sell this to someone else. This is why Buffett and Munger said,
as they say, it will often involve a different set of owners.
Yeah, and the buildings don't go away, but
the owners do.
The buildings themselves are not just going to magically disappear, but the owners who borrowed to the gills when interest rates were low are going to disappear. And there's going to be a new group of real estate owners who will snap up these properties, probably for a really nice price tag. For the savvy investor, there may be some opportunity here.
We've both had a fair amount of experience in real estate, and Charlie made his early money in real estate. The second point is the more important point. Real estate is not a commodity. I think it tends to be more accurately priced, particularly developed real estate, more accurately priced most of the time. Now, during the RTC period, when you had huge amounts of transactions and you had an owner that didn't want to be an owner in a very big way, and they didn't know what the hell they owned and all of that sort of thing. I mean, you had a lot of mispricing then, and I know a few people in this room that made a lot of money off of that. Occasionally, there have been some you know, there could be big opportunities in the field, but if they exist, it will certainly be because there'll be a lot of chaos in real estate financing for one reason or another. We've done some real estate financing, and you have to have the money shut off to quite a degree, probably to get any big mispricing.
One important thing to note about all of this is that the real estate market is a complex structure. It's not just one factor that influences it, but a bunch of intertwining ones. A mistake that people often make is just looking at one factor, making a prediction, and ignoring the rest. The wall of commercial debt coming due is simply one, big factor that influences commercial real estate. But what about the other factors? What about the American economy? What about the new government policies? What about the aging population with lower birth rates? All of this has its own push and pull on the real estate market. This is why, me personally, I'm a bit apprehensive to make a prediction on what the commercial real estate market will do as a result of the debt coming due. Who knows, maybe instead of a crash, we might just see flat prices for a while. It might not necessarily be a decline because of other factors pushing the market up. Real estate is a complex game. This wall of commercial debt maturing is a factor we must certainly take into consideration, but we need to take it with a nuanced perspective and also analyze the other forces at play too.